two types of equity related bonds, okay? Convertible bonds and bonds with warrant, okay? Convertible bond issue allows the investors to exchange bonds for a predetermined number of equity shares of the issuer. So basically you can, at your advantage, right? You can convert your bond into stocks when the stock price goes up like crazy, right? You can choose to stay, okay, as a bond, right? When the stock price is not that much going up, right? So you have the option to convert it. Now, so the floor value of a convertible bond is its fixed rate bond value, floor, and then option. Okay, convertible, so usually sell at the premium above the larger of their straight debt value and their conversion value. So because this is their option, it has maximum function over there. Okay, and then investors are usually willing to accept a lower coupon rate of interest than the comparable straight fixed coupon bond because they find the conversion feature attractive, right? And then these bonds allow the holders to keep the bond but still buy a specified number of shares in the firms of the issuer at the specified price. They can be viewed, these warrants, right? They can be viewed as a straight fixed rate bonds with the addition of a call option or a warrant feature. The warrant entitles the bondholder to purchase a certain number of equity shares in the issuer at a pre-stated cash price over a predetermined period of time. With a convertible bond, you surrender the bond to get the shares. With the equity warrant bonds, you can pay cash and keep the bonds, right? So you just have the right in this warrants case. Zero coupon bond is the next one. Essentially no coupon payment but the principal at the end of the period. So zero coupon bonds are sold at a large discount from face value because there's no cash flow until maturity. The cash flow, a whole bunch is happening at the long end. So the US investors in zeros or zero coupon bond owe taxes on the imputed income represented by the increase in present value each year, while in Japan the gain is a tax-free capital gain. So different countries have different tax rules for this zero coupon bond. Pricing is very straightforward. PV equals par value divided by 1 plus discount rate to the power of big T, the maturity, right? Dual currency bond, well, it makes it more colorful. So coupon payment in one currency and then the principal payment in another currency. So straight fixed rate bond with interest paid in the currency and principal in another currency. Japanese firms have been big issuers of this with coupons in yen and principal in dollars. And it's a good option for multinational corporations financing a foreign subsidiary. Okay. You see the timeline over here, N years of maturity. So you have coupons paid in Japanese yen, and then the principal paid in US dollars. Of course, there has to be Japanese yen as well for small coupon amount as usual, right? And then this is the principal. You remember the coupon is paid, okay, as long as it is paid at the end of the period. The last coupon payment has to happen at the same time with the principal payment, right? That's all that I'm saying. Anyway, that's that. Composite currency bonds. It is denominated in a currency basket like the SDRs of IMF, special drawing right, and ECUs, or instead of a single currency, often called currency cocktail bonds. Typically, it's a straight fixed rate debt. Okay, and then And then over here, US dollars, right? For example, there are two different currencies, Japanese yen, equivalent value of this guy, right? There you can infer some forward rate of Japanese yen and US dollars. And when you look at this dual currency bonds, right? What is the fair exchange? So much so that you are promising this kind of dual currency bonds. So that's implying the forward rate. Now, characteristics of international bond market instruments, straight bond all the way down to dual currency bond. You see it, right? And then the next is currency distribution of international bonds amount outstanding in billion US dollars terms is over here. So 2011 all the way down to 2015, right? Majority of them is issued in US dollar terms, right? And then euro comes next, and then pound comes next, like that. All right. Exhibit 12.5, right? International bond amount outstanding, classified by nationality and types of issuers. You can see it over here, 2011 to 2015 first quarter. By the way, these are at the end of the year, right? But why is it at the end of the first quarter of 2015? Because the textbook writers collected the data at the second quarter of 2015, I guess. So is it okay to compare year-end value with the quarter-end value? This one is okay because, why? These are snapshots. So stock amount, right? So it's not a flow amount over a certain period, okay? But at each time point, snapshot. That's why it's okay. And then, so in the developed country currencies, right? 29, right? Bond amount, outstanding classified by nationality. So the US, right? Nationality wise is the biggest one, okay? And then other countries are also, very big portion, right, over here. Anyway, the next one, international bond amounts outstanding classified by nationality and types of issuers, continued, right? Financial corporations and general government. Okay, international bond market credit ratings, right? I told you before that because bonds are issued to general investors in public, right? No bank is constantly monitoring this guy, right? Those issuers. So you need a third party who can certify, kind of, oh, this company is worth a certain credit quality, okay? And that company is lower credit quality. There has to be somebody doing that. That is called rating agencies. Fitch IBCA is a British organization or company who is doing that, or bond rating. Moody's and Standard & Poor's, right, S&P, they are credit rating agencies in the United States, and then focus on default risk. They just focus on this bankruptcy risk, and then they are not focused too much on exchange rate risk, and they are assessing, right, sovereign debt, and then assessing for the sovereign debt focuses on political risk and economic risk. Eurobond market structure is also discussed in the textbook. Primary market and secondary market. Well, this is the market where you issue this bond, right? This is very similar to US underwriting. Underwriting, why do you say underwriting? This comes from the insurance underwriting, okay? When you go to Lloyd's, the insurance market, right? That started as a Starbucks kind of cafe, I told you, right? There, the insurers, right? They were kind of making a deal about certain projects that seems risky. So if you want to be an insurer about such project going bankrupt or something, you write an insurance contract over here, right? So that you will cover such and such you will cover such enterprises in a certain way, and you write your name in this piece of paper. Okay, in this piece of paper, sign your name, and then write down the contracts, right? And there must be somebody who is initiating all these kind of things on the table, and then they post it on their cafe, okay? And then they were writing their name under this contract, so that the guy was called underwriter, okay, underwriter. And this kind of underwriting practice has been there in bond market as well. Who want to issue this bond? Well, I will issue a bond for you and write down all this contract and write down my name, sign over there, underwriting. And then whoever wants to join me helping you to issue your bond, right? Those investment bankers were writing their names over there together with you. Who is the lead underwriter? Okay, is an issue. Primary market is the one where you issue this kind of bond, and the secondary market is where it is traded. And then this one is not traded in exchange. Bond is not traded in exchange. Why is that the case? Because to be able to be traded in those exchanges, the product has to be very simple. But bond is not simple. You saw global bond, right? Global bond. Can it have some standardized features? No. The contrast over here, nice example of this exchange versus OTC is forward versus futures. We talked about it before. Futures is much more standardized. Forward is not. So it is more OTC, over the counter. And bond is also over the counter, okay, because of the same reason. It is not standardized, okay. Maturity and coupon payment frequency, whether it is annual coupon bond or semi-annual coupon bond, or how many years of maturity do you have it, right? And what kind of conversion feature is there or not, or bond with warrant or not, right? And then which currency is in? Is it dual currency or cocktail currency, right? Even with the same Samsung Electronics, they can have all variety of bonds over there. Okay, so it is not easily tradable minute by minute, second by second. Whereas Samsung Electronics stock, it's just common stock, one kind, right? You just have a right to get the dividend later on. Okay, you just have a claim to the cash flow. It's very simple. The only other kind of stock is preferred stock, right? Whereas in bond, it's much more complicated. So usually it is traded over the counter, right? In London, usually centered around over there, and it comprises of market makers as well as brokers, and market makers and brokers are members of the International Capital excuse me, Market Association. Oh, this has to be the typo. ICMA, International Capital Market Association, and this is a self-regulatory body based in Zurich. Why in Switzerland? I don't know. Okay, and in clearing procedures, well, Euroclear and then Settle handle the most euro bond trades. Now, Standard & Poor's sovereign rating framework looks like this. 5 key areas. I mean, this is about the rating agencies. The sovereign means the government treasury bond, right? Sovereign rating framework. Now, 5 key areas to determine a sovereign's creditworthiness is here: institutional assessment and economic assessment, and external assessment, fiscal assessment, and monetary assessment. That has to do with all macroeconomics, fiscal policy and monetary policy. How healthy are they, right? And then, okay, institutional and economic assessment. Well, institutional and economic profile is there, and then institution building of those countries, and then GDP kind of things, how economic growth, potential growth of this economy, right? And then flexibility and performance profile of the government, treasury, and then the central bank, all this kind of thing, factors get in there. And then sovereign indicative rating and level will be there accordingly. And then they have their own framework of doing it, right? There's a whole profession dedicated to this. And then supplemental adjustment factors and one notch of uplift or downlift, if applicable, is there. And foreign currency sovereign rating is given, assigned, and the local currency sovereign rating is also assigned later, right? The assessing 5 main sovereign rating factors. The analysis of each of the 5 key factors consists of quantitative and qualitative elements. Like, there's no strict rule says that, oh, debt to GDP ratio being higher than 40%, oh, you're a bad country, and then your credit rating, you go down to a junk bond level afterwards. There's no strict rule they're saying like that, because that's just one quantitative metric that you can base your judgment upon, but it is not a definitive one, because the other qualitative factors may affect differently. Okay, there's always a gray area. Some factors, such as the robustness of political institutions, are primarily qualitative, while others, such as those relating to the real economy, debt, and external liquidity, use most quantitative indicators. So this is partly why the internationally non-quantitative discipline guys still work in these finance areas as well. And then whenever you issue bonds, like there is some way of celebrating it. Those investment bankers celebrate their issuance track record using their tombstone, something called a tombstone. It's like a plastic kind of a celebrating 상패 kind of things, right? Or a panel that you plastic bulk that says like this. Oh, let's see. Let's read it over here. Hamburgische Landesbank. This sounds like German one. Hamburg Land Bank or Jutegnen kind of guys. Housing related guys, bank. They issued a bond. Okay. How much? $2 billion worth of bond. Okay. And then Euro midterm note program was there, and then now rated AA plus or AA1 by Moody's, right? And then who was the underwriters, right? Who was the investment bankers that were issuing this $2 billion bond to a bond for Hamburgische Landesbank? That issuer was Merrill Lynch. Underwriters was Merrill Lynch, not issuer. Issuers Landesbank, their borrowers, but the underwriter is Merrill Lynch International that you see down there. Okay, arrangers, they say it, and then Merrill Lynch Capital Market Bank Limited, and then Franklin main branch or whatever, and then Merrill Lynch Finance SA, and then not only them, there are other dealers, right, who is involved in this bond issuance. Credit Suisse First Boston, Hamburgische, and then it seems like they're Hamburgische Landesbank's other arms of investment banking arms. And then Merrill Lynch International, Morgan Stanley, and Salomon Brothers, and Deutsche Morgan Grenfell, that's the investment banking arm of JP Morgan, and then Merrill Lynch and Nomura and Warburg, right, is there. Anyway, now tombstones. Other tombstones that you can see is Toyota Tsusho Corporation. I don't know what that is, but must be related to affiliate of Toyota Motors, right? We can pretty much easily guess it. $500 million worth, right? US dollars worth of bond was issued due 2024, right? Coupon rate is specified, fixed coupon rate, 2.596%, and then issue price is 100% of his face value, which is this guy. And then joint lead manager and the joint, I can't read it, but jointly led by JP Morgan and then Bank of America Merrill Lynch and Morgan Stanley, and it was issued finally in September 2019. So the bankers table, right, and their shelf, if you visit their offices, they celebrate their performance by placing their tombstone in their shelves like that and brag upon, their performances. Ooh, I issued $2 billion worth, right? And Twitter also, one point, at one point, they issued a convertible senior bond. Note means bond, right? $1.15 billion, right? And then for the underwriters, well, Goldman Sachs, Morgan Stanley, JP Morgan, Bank of America, Merrill Lynch, Wells Fargo, and then I don't see what that is, Allianz or something. Anyway, so they have this kind of tombstone in all variety ways. Eurobond practices, primary market, well, a borrower desiring to raise funds by issuing Eurobonds to the investing public will contact an investment banker and ask it to serve as a lead manager of an underwriting syndicate that will bring the bonds to the market. Syndicate is the same thing. Syndicated loan, we talk about it. So it is a group of underwriters in this case, right? Group of underwriters working together. This underwriting syndicate is a group of investment banks, merchant banks, and the merchant banking arms of commercial banks that specialize in some phases of public issuance, right? And then the lead manager will sometimes invite co-managers to form a managing group, you saw that before, to help negotiate terms with borrowers, ascertain market conditions, and manage the issuance. And the managing group, along with other banks, will serve as underwriters for the issue. They will commit their own capital to buy the issue from the borrower at the discount from the issue price. And the discount or underwriting spread is typically in the 2 to 2.5% range. By comparison, the spread averages about 1% for domestic issues. Yeah, of course, domestic issues are a lot safer to issue from the perspective of the underwriters, so they charge lower fees. Most of the underwriters, along with other banks, will be part of a selling group that sells the bond to the investing public, right? So as an underwriter, you hope you can sell off all those bonds to the general investors in public, okay? So that you will be sold off, okay? Those bonds will be sold off. Yeah, and then you'll say bye-bye to the bond, right? 손 씻었어, right? 손 털어. Washing your hands, right? On the other hand, what if your bond that you issued is not popular and then nobody wants to buy it? Then you are screwed, okay? So in that case, if the bond underwriters is in full commitment based, then the underwriter sits on those bonds, okay? Which means the underwriter has to buy the bond on their account, okay? They take the full risk of it, okay? Whether this issuance of this bond is a full commitment based or just fully underwriting based is makes it different, okay? So you don't want to sit on that kind of risk, right? So that's another feature that you have to be careful about. Commitment based versus underwriting based. Anyway, Eurobond practices secondary market. Eurobond issue initially purchased in the primary market from a member of the selling group may be resold prior to their maturities to other investors in the secondary market. The secondary market for Eurobond is an over-the-counter market, as I said before, with principally trading in London However, important trading is also done in other major European money centers such as Zurich, Luxembourg, Frankfurt, and Amsterdam. Right. The secondary market consists of market makers and broker connected by arrays of telecommunications equipment. Market makers stand ready to buy or sell for their own account by quoting two-way bid and ask prices. Market makers trade directly with another through a broker or with retail customers, retail investors. The bid-ask spread represents a market maker's only profit. No other commission is charged. Okay. Clearing procedures. Eurobond transactions in a secondary market requires a system of transferring ownership and payment from one party to another. The two major clearing systems, Euroclear and the Clear Systems International, handle Clearstream International handle most Eurobond trades, and Euroclear is based in Brussels and is operated by Euroclear Bank. Clearstreams is located in Luxembourg. Okay. Both clearing systems operate in a similar manner. Each clearing system has a group of depository banks and physically store bond certificates. Members of either system holds cash and bond account. When a transaction is conducted, electronic book entries are made that transfer book ownership of the bond certificates from the seller to the buyer, and transfer funds from the purchaser's cash account to the seller's cash account. Physical transfer of bonds seldom takes place. So even though I showed you the bond document, right? That's like 100 years ago, a classic form of it. Nowadays, it's all electronic. And other functions of the clearing system, Euroclear and the Clearstream performs other functions associated with the efficient operations of the Eurobond market. The clearing systems will finance up to 90% of the inventory that a Eurobond market maker has deposited within the system. The clearing system will assist in the distribution of a new bond issue. The clearing system will take physical possession of a duly printed bond certificates in the depository, collect subscription payments from the purchasers, and record ownership of the bonds. Now, lastly, the clearing system will also distribute coupon payments. The borrower pays to the clearing system the coupon interest due to the portion of the issue held in the depository, which in turn credits the appropriate amounts to the bond owner's cash accounts. And international bond market indices are also there. There are several international bond market indices. JP Morgan and Company keeps all those things, not all, but many of them. Domestic bond indices, and then international government bond index for 18 different countries, widely referenced and often used as a benchmark, and it appears daily in the Wall Street Journal. So that's pretty much it for this chapter, right? A lot of institutional details are shown over there. But a key interesting thing that you should remember is foreign bonds versus Euro bonds. Arirang bond versus Kimchi bond. Samurai bond versus Shogun bond or Geisha bond, right? All these things, right? And then floating rate notes, right? Interest rate risk, all these kind of things will be important for you. Anyway, so I hope you liked it. So see you in the next lecture.